Here's something that most financial commentary will never tell you. In the space of 1 week, a single narrow stretch of water, just 33 kilometers wide at its tightest point, has put 21% of the world's daily oil supply at risk, triggered a fertilizer supply crisis that could hit consumers in potentially 6 months, and sent insurance markets into a spiral that no government has been able to stop. We're talking about the Strait of Hormuz, and right now it's effectively closed, not by a naval blockade or by a war, but by global insurance industries. I'm going to walk you through what's happened, what's flowing through the waterway, and why this is a race against the clock. And most importantly, what it actually means potentially for your investments, your business, and industry as a whole. Because here's the thing, investments themselves never exist in isolation. Markets are globally interconnected. And what's unfolding right now is the textbook case of how world events transmit through energy, agriculture, shipping, and manufacturing, all at the same time. Now, my name is Richard, and welcome to Ron's Industries, the industry blog for investors where we're pro-wealth, pro-growth, and pro-industry. And today we're going to try to look at how we can all get affected by what's taking place in the Middle East. So let's get into it. So let me give you the timeline, because the speed of this escalation is important context for everything that follows from this point forward. The strategic tensions that drove this had been building for some time, but the trigger point, the moment when this became a market event, was the 28th of February. Now, by Monday, the 2nd of March, markets were still relatively calm. Iran had launched retaliatory strikes against Bahrain, Qatar, the UAE, Kuwait, Saudi Arabia, before extending attacks to Azerbaijan, Cyprus, and to Turkey. Now, that's a significant number of countries, but at that stage, the financial systems either hadn't fully processed what was about to happen or judged the rapid exchange of explosives between neighbors that it didn't particularly matter. Now, by Tuesday, that's when the sell-off started. And it wasn't driven by the military strikes themselves. It was driven by what happened in the insurance markets. And that's when hull insurance for very large crude carriers, or VLCCs, the enormous tankers that carry the world's oil and liquefied natural gas, jumped overnight from around about 0.25% of hull value to about 3%. Now, that might sound like a pretty small number, but here's the context. For a vessel that's worth, say, $250 million, that's an insurance bill moving from a roughly around about $625,000 to $7.5 million in a single week. And there's precedent here. During the Ukraine conflict, hull value insurance for vessels in risk zones climbed as high as 5%. Now, markets know this precedent, insurance underwriters know this precedent, and they acted accordingly when they saw the problem. Now, the insurance industry's response essentially was, we don't want you sailing. Full stop. The US administration has reportedly moved to offer up to $20 billion in insurance backing to keep vessels sailing and to keep the supply chains for the globe open. Now, vessel owners have faced a simple commercial decision. Do they absorb an uninsurable financial risk in an active conflict zone, or do they stop sailing? And the vast majority have stopped sailing. By the 5th and 6th of March, Thursday and Friday of the same week, China had announced it was ceasing all exports of finished petroleum product, basically deciding to keep fuel for its own economy. And that's when markets went into meltdown. And by the following Monday, 1 week after the conflict's financial impact began to be felt, crude oil had surged more than 20% in a single trading day, and we were above $109 a barrel. So to understand why this matters so much, you need to understand what actually transits through the Strait of Hormuz on a daily and monthly basis. Because this waterway isn't just about oil, and that's where most commentary to date has seemingly fallen short. Now, on the energy side, the Gulf Coast countries, and that's the UAE, Bahrain, Qatar, Saudi Arabia, Oman, Kuwait, and Iraq, export about 21.4 million barrels of oil per day. That represents around about 21% of global oil supply flowing through one strategic choke point. Now, Saudi Arabia alone represents approximately 7% of global oil supply, with China the primary destination and 14% of China's supply alone. This same 14% risk is directly linked to China's decision to stop its export of refined product. And then there's LNG, liquefied natural gas. The Middle East exports somewhere in the order of 80 million metric tons of LNG annually through this route. Now, for countries that depend on gas for electricity generation, industrial processes, inputs, or finished product, this is an absolutely crucial supply line. But here is the part that has received almost zero mainstream coverage, and we're talking about fertilizer. The Middle East and Gulf Coast countries account for 30 to 35% of global fertilizer exports. Every month through the Strait of Hormuz, we see flows of between 1.5 and 1.8 million metric tons of sulfur, between 1.2 to 1.5 million metric tons of urea, and approximately 400 to 500,000 metric tons of ammonia and phosphate. Now, these are not secondary inputs. Urea, ammonia, phosphate, and sulfur are the foundational building blocks of the global agricultural supply chain. No fertilizer, or sharply more expensive fertilizer, means lower crop yields, higher food prices, and food security stress. And we'll come back to why the timing of this makes it particularly dangerous. Now let's talk about the piece of this analysis that I think is most underreported, particularly if you're in Australia or operating in the Asia Pacific region. Now, a lot of coverage has framed this as a US story. America is an oil exporter, so that means that higher prices are good for US producers. This is technically true in isolation, and it's also dangerously incomplete as an analysis. Now, here's why. The United States doesn't have spare capacity sufficient enough to compensate for 20 million barrels per day shortfall in global supply. But more importantly, the refining and the supply chain story for the Asia Pacific region is almost entirely dependent on the Middle Eastern sour crude. Now let's consider how Australia actually gets its fuel. Between 80 and 90% of Australia's finished petroleum products, and that includes petrol, diesel, and jet fuel, come through refineries based in Japan, South Korea, and Singapore. Now, those countries don't produce the crude oil themselves. Now, according to the published stats, South Korea ranked the 44th largest oil producer, Japan the 47th largest oil producer, and Singapore the 76th largest oil producer, only produce around about 113, 102, and 20,000 barrels per day respectively. At the same time, those countries based on consumption need to import 95, 97, and 99% of their oil energy needs respectively. They import it, they refine it, and they export the finished product. Australia gets its oil as refined surplus, which they export. So where do they get their crude? Japan sources 90 to 95% of its crude oil from the Middle East. South Korea approximately 70%, and Singapore approximately 70% as well. Now, what this means is that Australia's fuel security is not one step removed from the Middle East, it's two steps removed. The crude has to flow through the Strait first to get to Asia. It then has to be refined and shipped to us. Both links in that chain are now compromised. So Qatar has already shut down one of its LNG terminals in Ras Laffan, and restarting production could take 2 weeks, and then an additional 2 weeks to hit full production from there. So we've got one decision leading to a 1 month minimum disruption. So Australian fuel prices are already moving, and this isn't just forecast, it's already happening. We're already at $2.20 per litre or $5.82 US per gallon. Any business in Australia that relies on fuel, such as logistics, agriculture, aviation, manufacturing, or just people getting to work, it's going to feel this in the cost base. And it's going to be felt in as little as days once vehicles need to fill up again. The same logic applies across Southeast Asia and the broader Indo-Pacific. The dependency on Middle Eastern crude is structural, not incidental, and it can't be quickly substituted and that's if it can be done at all. So let's add the China dimension, because this is the multiplier that most people are missing. China is the world's largest net importer of crude oil, somewhere in the order of around about 11 million barrels per day. Now, under normal market conditions, China had also been purchasing crude from certain suppliers, including Iran, which produces around about 4 to 4.5 million barrels per day at significant discounts. We're talking about reported figures approximately 15% below market rate. Now, with the conflict, that discount supply is going to be disrupted. And China's response has been to immediately cease all exports of finished petroleum product, reserving domestic supplies for its own economy first. Now, think about what that does to second order economics. China now potentially needs to source oil at full market commodity price. Its energy inputs cost rise, and because China is the world's dominant manufacturer and exporter of finished goods, consumer electronics, industrial components, clothing, appliances, and the list goes on, those higher input costs get passed downstream to global consumers. Now, we're already an interconnected global supply chain. When China's cost base rises, it shows up on the shelves in Sydney, London, Chicago, Nairobi, all in the space of months. So currently we've got simultaneous pressure on the oil price itself, the direct energy cost, the cost of goods manufactured in China and everywhere else, the indirect consumer inflation, and the fertilizer supply chain, which we'll come to. So we've got three vectors of inflationary pressure activating all simultaneously. Now, I want to talk about something that I think deserves a lot more attention than it's getting. And that's the agricultural dimension of this global event, combined with where we are in the calendar right now. The Northern Hemisphere is in spring. That means farmers across North America, Europe, and large parts of Asia are either actively planting or in the final window before they do. The crops that go into the ground in March and April will be harvested in September and October. And you can't replay or shift the planting season around. You've basically got one shot. Now, urea prices have already moved. We're seeing urea trading above $450 per tonne, and that's an increase already of more than 10% in a very, very short space of time. Depending on whether those prices have been passed on now, that cost could land on farmers before a single seed goes into the ground and before diesel goes into the tractor. Now, here's the compounding effect. You've got energy prices rising, which drives up the cost of fuel for machinery, transportation, cold storage. You've got fertilizer prices rising, which both increase input costs and, if supplies are constrained enough, risks yield reductions on the crops themselves. And both of these are activating simultaneously at the precise moment farmers need to be locking in their input purchasing decisions if they haven't done it already. Now, in the southern hemisphere, winter crops being planted out until July and summer crops planted from September to February have a likelihood of being far more expensive in the future. The downstream consumer price impacts won't appear immediately. It could be coming with as little as a 6-month lag, because that's how long it takes for the cost to move from the farm input through the growing season to harvest to processing to shelf. But that's the 6-month clock, and it started ticking at the beginning of March. For businesses in food manufacturing, grocery retail, agribusiness, and food services, the cost of goods inflation from this season is already locked in. The question is now, by how much? And this agricultural pressure is also a geopolitical multiplier. Nations in Europe, Africa, South and Southeast Asia, and the Americas all have material national security interests in seeing fertilizer and grain supply chains restored. That political pressure on all sides to reach a resolution, and it's quickly becoming real and it's building. So let's bring this home to what this actually means for you, whether you're an investor, a business owner, or both. First, there's energy. The price of crude has already pulled back on the $110, $120 peak last week, but oil above $100 is now a potential scenario. This could be a structural repricing for as long as the Strait disruption continues. Energy producers outside of the Middle East, namely US shale, Canadian oil sands, Australian LNG exporters, they stand to benefit from a sustained price premium. But watch for demand destruction. Prolonged high energy prices eventually slow economic activity, which caps the upside. Secondly, you've got shipping and logistics. The insurance market mechanism is the key transmission channel here. Any business relying on maritime supply chains through the Gulf region needs to stress test for rerouting costs, extended delivery timelines, and insurance pass-throughs. Now, this isn't temporary. War risk premiums persist for the duration of elevated threat environments. If your logistics costs are currently based on pre-conflict assumptions, then those assumptions are now completely out of date. Thirdly, there's agriculture and food manufacturing. This is arguably the most underpriced risk in the current market discussion. Fertilizer contracts, fuel hedging positions, and input supply diversification need to be reviewed immediately. The 6-month lag means that there's still a narrow window for a strategic positioning, but it's closing fast. And fourth, consumer goods and retail. With China's manufacturing cost base rising and global energy and input costs elevated, imported goods inflation is not a risk, it's a near certainty. If you import finished goods from Asia, you should be modeling a cost of goods scenario that's potentially 10 to 20% above today's levels. The questions for every retail and importer is, how much of that can you absorb? And how much is going to get passed on to the consumer? So the 4 key watch points I'd be monitoring right now are, firstly, the duration of the insurance-driven strait closure, which is the master variable. Secondly, whether or not China sustains or eases its petroleum export restrictions. Open shipping could see this relax as quickly as it was tightened. Third, the trajectory of the fertilizer pricing into agriculture. And fourth, the pace of diplomatic engagement from third-party powers with a direct stake in the outcome, such as Europe, India, China itself, and the broader Gulf states. Now, some economic commentary has suggested that this conflict is entirely centered around oil, and floated timelines of anywhere between 6 months and even 6 years for things to play out, before shifting their focus solely on combat and security implications and ignoring everything else. I want to be direct here. I don't know and won't speculate on how long the conflict or disruptions to shipping will last. There is a probability of a 6-month disruption, the same as that there's a probability of a 6-year disruption. But considering all of the external factors here, that's why I can't see this lasting that long. Now, a 6-month disruption to the Strait of Hormuz would be absolutely and utterly economically devastating on a global scale. Not just for the countries directly involved, but for virtually every nation that depends on stable energy and food supply chains, which is everyone. The good news, and I do think that this is genuine good news, is that the pressure for resolution is not just coming from the primary parties. Speed and urgency are intrinsic considerations that are clear to see in this conflict. Pressure for immediate resolution is coming from every importing nation that needs fuel in their refineries, every farmer that needs fertilizer in their soil, and every government that doesn't want to explain food and energy inflation to their citizens in any sort of election cycle. That convergence of pressure is one of the most powerful forces towards de-escalation that there is. Every single day that this continues, the pressure to resolve it intensifies, economically, diplomatically, and politically. This is a conflict that must be fought, if it must be fought at all, with extreme precision and resolved as fast as possible. The strategic, economic, and food security calculus all point in the same direction. The faster that this ends, the better the outcome for global markets, global consumers, and global stability as a whole. So the bottom line is this. No investment, no business, and no supply chain exist in geopolitical isolation. What's happening in the Strait of Hormuz right now is a live stress test of that truth. The businesses and investors who navigate this period will be the ones who look past the oil price headline and into the deeper issues that refining supply chains and insurance market and the agricultural calendar. The businesses and investors who navigate this period the best will be the ones who look past the oil price headline and into deeper issues such as the refining supply chain, the insurance market, and the agricultural calendar. The impacts are real and they are already here. The full consequences are still unfolding. Now, if you found this useful, I'd love you to subscribe and drop a comment below with what you think is the most underreported angle of this crisis. I'd genuinely like to know what you're seeing. But on that note, my name is Richard. Thanks for watching. Stay sharp out there.